Good morning. I'm Dr.S.Selvakumar from the Department of Agricultural Biotechnology, Bharat Institute of Higher Education and Research. Today, we are going to see U18Hsbt601 Entrepreneurship Development. The topic is business finance. Okay, let us start one by one. What is business financing? What is the meaning of the business? So, business financing is nothing but the money needed for carrying out the business activities is called business finance. The definition of business finance is refers to it can be broadly defined as the activity concerned with the planning, raising the business, controlling the business, and administering of various funds used in the business is called business financing. Next, I'm coming to the important characters of the business finance. So, the finance is the basic requirement of any business. It is considered as the lifeblood of business. It is the amount of money or funds or the capital needed for the smooth functioning of any business. And the business finance is needed at every stage of the business, from the promotion to liquidation. So the adequate finance mostly are needed for orderly the functioning of a business. And the promoters need to calculate the financial needs through a prompt financial planning. Next, I'm coming to the purpose of business finance. So there are the three important purpose of business finance. Number one, the proper financial management is very important, and the sources and applications of the funds. Therefore, the finance affects the profitability, growth and survival of a business. Without finance, no business. So next I'm coming to in continuation of the purpose of business finance. So the business finance is the process of raising, providing and managing of all the money that is to be used in the connection with the business activities. The business finance is the finance needed for conducting the business activities. The modern business needed a huge amount of fixed and working capital for conducting the business successfully. So next, the salient features of the business finance is deals with the financial aspect concerned with the estimation, collection, and utilization of the funds collected. And it needs a proper planning and proper control. And third important one, the objective oriented business activities. Next, the major aspect of the business management that should be dynamic in the future. So the business needs are the different types of finances. It's collected from the different sources. Next, the role of business finance in a particular company or particular firm or particular organization. So it affects the survival, profitability, and growth of the institution. It is necessary for the promotion of an organization. It ensures the orderly functioning of an organization. So the finance is the backbone of every business because without finance, no business, and it brings the stability to the enterprise. Next, the expansion, the modernization, and diversification is possible. One, when there are adequate money or funds available in the firm. It supports the other functional areas of the business. It helps meeting the objective of wealth maximization. The business finance helps the firms to solve the business related problems. Next, we come to the principles of business finance. So, the basic principle is the complete utilization of the funds, the maximization of the returns on the investment, the survival and the prosperity of the business unit, the fair balance between the liquidity and profitability is very important. The final one, the very good public image of the firm. Next, I'm coming to the need of business finance. Number one, the fixed capital requirement. That is, the funds to purchase certain fixed assets is called fixed capital requirement. The second is called working capital requirement. That is, the amount needed for day-to-day operations. That means the working capital. Right. Next, what are the factors affecting the choice of the sources of the funds? There are different factors are there. Let us see one by one. Number one, cost. Number two, the risk profile. Number three, the purpose and time period. Number four, the tax benefits. Number five, the flexibility and ease. Number five, the flexibility and ease. Number six, the financial strength and stability of the operations. Number seven, the form of organization and the legal status. And number eight, the effect on the credit worthiness. Next, third, the classification of sources of the funds. There are three different terminology which is used for the business finance on the basis of the periodic basis. The classification based on the periodic basis. That is long term, medium term, short term. Long term in the sense 5+ years or 5 more years. The medium term should be minimum 1 year to maximum 5 years. The short term means minimum 1 year and little more. It's called short. Next, the classification on the basis of the ownership. So, the owner fund or the owner borrowed funds from the other sources. It's called owner's fund. Third source is called the generation basis. That is, internal source or the external source. That means the fund generated from the internal source or the funds are taken from the outside. That is external source. Next, I'm coming to the sources of capital. So there are different sources of capital. I will tell you one by one. Number one, the retained earnings. Number two, the trade credit. Number three, the factoring. Number four, the lease finance. And number five, the issues of the shares. That means either equity or preferred share shares. Let us see one by one. In continuation of sources of the six, the public deposits. Number seven, the commercial paper or number eight, debentures. Number nine, the commercial banks. Number 10, the financial institutions. Let us see one by one what is the retained earnings. So the profits mostly generated by a company that are not distributed to the stockholders. That means to the shareholders as the dividends. But they are either reinvested in the business or kept as a reserve for scientific objectives, such as they pay off a debit or purchase a capital asset is called rate earnings. Now we are going to see what are the benefits or merits of retained earnings. Number one, the retained earnings is the permanent source of funds available to an organization. Second point, it does not involve any explicit cost in the form of interest or the dividend or the flotation cost. The third merit is as the funds are generated internally, there is a greater degree of operational freedom and flexibility. Next, we are going to see what are the drawbacks or limitations of retained earnings. I'll give you three important points. The excessive flowing back may cause dissatisfaction amongst the shareholders as they would get the lower dividends. Very important. Second drawback, it is an uncertain source of funds as the profit of business are fluctuating. Third important drawback, the opportunity cost associated with these funds is not recognized by many reputed firms. Third, next we'll see the second thing, trade credit. What is trade credit? So the trade credit is refers to the credit extended to you by suppliers who let you buy now and pay later. So anytime you take delivery of materials, raw materials, equipments, or any byproducts or other valuables without paying cash immediately, or that is on the spot, you are using the trade credit. What are the merits of trade credit? So the trade credit basically is the convenient method and the continuous source of the funds. The trade credit may be readily available in case the credit worthiness of the customer is known to the sellers. The trade credit need to promote the sales of and firms or the organizations. If an organization wants to increase its inventory level in order to meet the expected rise or increase in the sales value in the near the future and limitations of trade credit. We give 3 minutes. The availability of easy and flexible the trade credit facilities may induce a firm to indulge in overtrading, which may be added to the risk of the firm or the organization. The second limitation, only limited amount of funds can be generated through the trade credit. And third important limitation, it is generally a costly source of the funds as compared to most other sources of raising money for the business. Next, I'm coming to factoring. What is factoring? So, the factoring is a type of finance in which a business would sell its accounts receivable, that is called invoices, to a third party to meet its short-term liquidity needs. So, under the transactions between both parties, the factor would pay the amount due on the invoices minus its commissions or its fees. Third, factoring. What are the advantages of factoring? That is, merits of factoring. So there are differential merits of available. So the obtaining funds through the factoring is cheaper than the financing through the other means of activity, such as bank credits. The second important advantage of the factoring, with the cash flow accelerated by factoring, the client is able to meet his or her liabilities promptly as and when these are arises. A third important merit of factoring. So the factoring as a source of fund is flexible and ensures a definite pattern of cash inflows from the credit or debit that a firm might otherwise be unable to obtain. Next, we are going to see the limitations of the factor. Drawbacks. This source is expensive when the invoices are numerous and smaller in the amounts. The advanced finance provided by the fact the firm is generally available at the higher interest or higher interest cost than the usual rate of interest. The third important factor, the factor is the third party to the customer who may not feel comfortable while dealing with. These are the limitations of the factor. Next, coming to lease finance, leasing or lease finance. The lease financing is one of the important sources of the medium and the long-term finance. The owner of a particular asset gives to another person the right to use the particular asset against the periodical payments. The owner of the asset is called lessor. The user is called lessee. So lessor, lessee. Who is lessor? The owner of the asset is called lessor, and the user of the asset is called lessee. So keep in your mind, lessor, lessee. Next, I'm coming to the merits of lease finance. There are many advantages of leasing finance. Number one, it enables the leasing to acquire the asset with the lower investment. Second point, the simple documentation makes it easier to the financial asset. The lease rentals paid by the leasing are deductible for computing the taxable profits, and it provides the finance without diluting the ownership. Very important, underline. It provides the finance without diluting the ownership or the control of the business. So without diluting the ownership or control of the business. Next, I'm coming to the drawbacks or the limitations of lease financing. There are different limitations of the lease finance. Point number one, the lease arrangement may impose certain restrictions on the use of assets. The normal business operations may be affected. In the case of lease, is not renewed. So important. The normal business operations, underline, the normal business operations may be affected in the case of the lease is not renewed properly. But it may result the higher payout obligations in the case of equipment is not found useful, and the leasee opts for the premature termination of the lease agreement. Next, coming to very important one, public deposits. The public deposits refers to the unsecured deposits invited by the companies from the public, mainly to the finance working capital needs, that is money needed for day-to-day business activities. Second important, a company wishing to invite the public deposits makes an advertisement in the newspapers. Right. Any member of the public can fill up the prescribed format and deposit the money with the particular company. The company in return issues a deposit receipt. This receipt is an acknowledgement of debt by the company. The terms and conditions, that is very important. The terms and conditions of the deposit are printed on the back of the receipt. The rate of interest and the public deposits mainly depends on the period of a deposit and the reputation of the particular company. What are the merits of deposits? Right. The procedure of obtaining the deposits is so simple and does not contain the restrictive conditions as they are generally in the form of loan agreements. So the public deposits do not usually create any charges on the asset of the company. The assets can be used as a security for raising the loans from the other sources. Is more or less similar to mortgage loans. Next, the limitations. The new companies generally find it difficult to raise the funds through the public deposits. It is an unreliable source of finance as the public may not respond when the company needs money, and the collection of public deposits may prove difficult, particularly when the size of deposits required is large. These are the limitations. Next, we coming to CP, that means commercial paper. The commercial paper or CP is defined as a short-term, unsecured money market instrument. What is CP? The commercial paper defined as a short-term, unsecured money market instrument, and it is issued as a promissory note by the big corporations or limited companies having excellent credit ratings. As the instrument, it is not backed by the collateral, but only the large firms or organizations with the considerable financial strength are authorized to issue the instrument. What are the merits? The commercial paper is sold on an unsecured basis and it does not contain any restrictive conditions. As it is freely transferable instrument, it has high liquidity. It provides more funds compared to the other sources. A commercial paper provides a continuous sources of funds to the organization. The companies can park their excess funds in the commercial paper, thereby earning some good returns on the same. Next limitation. Only the financially sound and high-rated organizations can raise money through the commercial paper. It is not up for the small level startups or companies. Second important limitation, the size of money that can be raised through the commercial paper is limited to the excess liquidity available with the suppliers of the funds at the particular time. Third important factor, the commercial paper is an impersonal method of finance. Next, I'm coming to the equity shares. The equity shares are the main sources of the finance of the firm, and it is issued to the general public. The equity shareholders do not enjoy any preferential rights with regard to the repayment of the capital and dividends. So they are entitled to the residual income of the company, but they enjoy the right to control the affairs of the business, and all the shareholders collectively, they are the owners of the company. Next, I'm coming to the preferential shares or the share preferences. The preferences of the shares allows an investor to own a stake of the company with a condition that whenever the company decides to pay the dividends, the shareholders of the preference, the shares will be the first to be paid. These shares are with no voting rights, which receive the dividend before all other shares and are rapid first at face value. The companies goes into liquidation. It is a very important factor. Thank you.